Hey, sorry. Welcome to another Foresee Markets episode. How you doing today, man?
That was great. How are you, Alejandro?
I'm doing all right. And hello everyone who's joining us today. We have, we've been looking at the stock market this past couple of weeks, and it's been pretty stagnant, and it just started to drop. So we're analyzing what's happening with the market and if there's really any safe place to put your money. So that's what we're gonna be talking about today. So, Sergey, you got any comments about that before we jump in?
Yes, it will be really interesting to see how our portfolio is looking at the moment. Like what strategies are we using to cope with falling markets, and how it can be done with fear and greed. So what are we doing about fear and greed?
All right, all right. So I'm gonna share my screen as always, just to get things moving. And so we're gonna start with the VIX, right? So the VIX is an interesting animal. What happens here at the VIX is that the CBOE, or the Chicago-based Options Exchange Commission, created this measurement that measures how people react to what's happening in the broader stock market. So here we're comparing the volatility of the S&P 500, and what we see here is that whenever the S&P, which is the line at the bottom, tends to drop just a little bit, the VIX spikes rapidly. But also whenever the stock market goes back into, a more stable mode, like what happened here, where it's going off, then the VIX drops again, and then when it drops, it increases, and so on and so forth, right? So they are um, anti-correlated by about a factor of zero point 0.7 to zero point 0.8. So over time, anyone who is trying to see how much fear there is in the market, they look at the VIX, and whenever they see that the VIX is spiking, they reposition themselves in a way that's going to protect their assets. And they do this by buying options, right? So we talked about options in a previous episode lightly. So what an option does is, let's say that you are the buyer of an option. That means someone else sold you this insurance, we'll call it insurance, and they said, if the stock market drops below a certain threshold, the assets that you have secured with this option contract will be purchased at the price that we have agreed upon. And you, as the buyer of the option, can then go in and pay for a premium for this particular guarantee. So what happens here when you see these spikes, this is basically the Chicago-based Options Exchange Commission saying we have a lot of sales in options, and we're seeing that there is a huge incline in the VIX, right? Which is what this is measuring, is measuring how much fear people are having in the stock market.
So basically, as far as I understand, VIX is like volatility index, right? And it shows how volatile the market is at the moment. And at the same time, it shows the fear. So if there's a lot of fear on the market, so a lot of people doing rapid movements of their assets, or selling, buying, which creates rapid movements of the price of the asset, which triggers volatility. And this is actually this exchange created actually the instrument where you basically can invest into the volatility, correct?
Yeah, exactly. That's what you're putting your money into, is investing in the volatility of the market. So what you see here is that when there's definitely times when the S&P 500, the line at the bottom, crosses the VIX, which is the line at the top. So if we look at this over time and we try to investigate how this is operating, if we look at it over the last 6 months, it's the same pattern continuously. Whenever the stock market, like the S&P 500, is dropping, the VIX is going to go up. And very small movements in the market cause big movements in the VIX, like the VIX percentage.
Is it like 50% movement? So from 50 to 100?
Yeah, like you see that here, it's like 100% increase just because of a little bit of a change. And this happened in March 26, right? Like right around March 26, this is when we had the first announcement of the U.S. bombing Iran. And when that happened, this is when the VIX started to spike. And then right around here, around March 30th, if I remember correctly, I think this is when they start to talk about peace. So they were getting bombed for a while, right? And then right here on the 30th, they start talking about peace, and then all of a sudden, the VIX starts to drop, and the S&P 500 starts to go up. Then you see here on June 26th, which was about a month ago, we start to get a few more fears. This is when when you're looking at the news, we start to see that there's more volatility happening. So over the last 5 days, you start to see here that the VIX started to increase, right? And so what we have over the last 5 days is that the United States and Saudi Arabia are, and the broader market are being affected because the Red Sea is being attacked by Yemen. So ironically, this is blocking another 10% of oil. And so now having all of this oil getting trapped in one single area is causing a lot of volatility. So what happens? Well, if we look here, whenever the price of oil is going up, as you see here, this is the price of oil lying on top, the stock market, the broader stock market tends to drop. So it's seriously affected. So as you see here, when oil is dropping, that's the line at the bottom, the S&P 500 tends to go up. As oil starts to go up in price, the S&P 500 starts to drop. So
This is what is called anti-correlation, right? The plots are going opposite directions. So zero point 0.7, 0.8 is like very, very high, very strong correlation factor.
yeah,
Yes.
they have a really, really strong correlation between, like, this is the Vanguard S&P 500, and then the one at the bottom is USO. So USO is what tracks the prices of oil. So here we are seeing that as the prices of the S&P 500 are dropping, the prices of oil are going up, right? And you see like these huge spikes here. And then you see these really large drops here. So they are like basically one for one correlated. So if we're looking at the price of oil individually, the price of oil had a really large spike on July 22nd. I think this is when hostilities between the United States and Iran started again. We had a large spike. Now over the weekend, there was talks that the U.S. and Iran may be like having peace talks again. So we see the price of oil is dropping, but the S&P 500, it takes a little bit longer to react to this. So even though this one is dropping, this one is stabilizing. It doesn't mean like it's going to go up just yet. So in order for the S&P 500 to go up, people have to start buying shares of stocks that live within the S&P 500. So then you have to see what are the different companies that make up this conglomerate. The S&P 500 is pretty large. It's got like 500 companies in it. So if you invest only on the S&P 500, you're going to be, almost at a disadvantage because you're not going to have as much exposure as you want. You're like actually exposing yourself to the entire market as opposed to like one or two shares. So what we've done is we have created an algorithm that tells us what are the best performing stocks. We have like all the way down to 12, but we're only going to be talking about the top 3 performers. So each one of these belong to a different sector, right? And what we're saying here is that the companies that are the most likely to hold their value during these times of volatility are the ones that have the strongest fundamentals compared to other stocks within their same sector. So we're saying that within the consumer sector, right, where you have Amazon and Costco and Booking, and for some reason this did like 1, 3, and 2. It's actually more like this where we have 1, 2, and 3, but the algorithm just like flipped them on the table. It just did that. Anyways, so here we see that Amazon is the top performer of all the companies within its own sector. So what sector does Amazon belong to? Consumer discretionary. So we're saying that within the consumer discretionary sector, Amazon is going to be the best one, followed by Costco, and then finally Booking. So if we look at these three companies, let's see how they're actually performing, right? So we're gonna say Amazon stock and MCM stock, and we're looking at it over the last 30 days. It is dropping, but is it dropping any more than Booking or Costco? So from here, it was at 240, went all the way down to 132, along with the broader market. If we look at it over the last 6 months, it hasn't really performed very well, but it's holding its value, right? If we check Booking.com, BKNG stock, this one is going up. If we look at it over the last 6 months, it's actually dropped by comparison, right? It was at 200 and now is down by 10%. But if we look at Amazon over the last 6 months, AMCN, over the last 6 months, it's dropped by 5%, right? So when you're trying to look at which companies are going to hold the most value, you want to look at their strengths, right? And if we are in a bear territory where you have two companies dropping because the broader market is dropping and you're trying to figure out where do I put my money? I don't want to keep it cash. Then you want to try to ensure that you keep it within the companies that are more likely to hold value. So let's compare Amazon and Booking side by side and see how they're folding. So we're gonna do duplicate here. We're gonna put this one and this one since these are the two that we're looking at. And then move this out of the way. And we're gonna do 6 months here for Amazon. And change this to Booking. Okay, so this is dropped by 9.7% over the last 6 months. This one is dropped by 5.22% over the last 6 months, right? So what the algorithm is telling us is that all of the companies are dropping. We are in bear market territory. But if you're looking at sector-specific companies, Amazon is more likely to hold value than Booking within that same sector. So then you have to ask yourself, okay, where do I want to buy? So what this is saying is that if you are going to buy Amazon, the support price for Amazon is going to be $207.99. So it's basically saying that whenever Amazon has come close to this price, people have started to put money on it, right? People believe that this is the price that Amazon is worth right now. So they start buying it. So the buying pressure pushes the price back up. And that's why it's called a support. And this is saying if you want to sell a put at this price, you can sell a put at $205 and you got to get a premium of 75 cents per share, which basically means that you are saying, I am willing to buy Amazon at $205 or less. And because of that, the market will pay you 75 cents, which means you are covered all the way down to $204.25 per share. That's how you can use the puts. What does that mean? If we bring everything together, it basically means that if you are looking at the VIX and you see that the VIX is starting to increase, then it's pretty certain that the S&P 500 as a whole will not be increasing, right? Because there's a lot of fear and people are pulling the money out from the market. So if you're a smart investor like Warren Buffett, he always says you want to buy when everyone is selling and you want to sell when everybody is buying. That means that you want to try to buy right around here. Like when this gets to the highest peak, that's when you want to start investing in the S&P 500. So are we at that peak right now? Well, it seems to be, right, because we had a very large spike here. This was very close to a similar spike before. And now the S&P 500 is stabilizing. So if you want to enter into the whole S&P 500, you can either buy SPY or you can buy VOO, or you can buy the individual stocks that make up the S&P 500. Me personally, I'm going to be buying Amazon and I'm going to be buying it to a put. So I'm buying two puts for Amazon, which are going to cost me $41,000, right? So 205 times 200. Let's make sure I'm not lying. So equal to 205 times 200, right? $41,000, just like I said. And I'm going to be making $150 premium on that because it's equal to 0.75 times 200. So we're going to say here equals to 0.75 times 200. right? $150. So I can take $150, go buy myself a nice steak, and realize that I am going to be entering Amazon for 200 shares below market price if it happens to get assigned. And because I can see that the VIX doesn't seem to be spiking any higher than it already did, then I'm pretty certain that I'm going to make a profit on Amazon when I sell it as it gets close to the resistance. This is how I invest when we have a bear market territory.
This is really interesting spin-off of algorithm for Vera markets, where you can literally look at some human sphere and decide like where to enter, when to exit. And this can be like pretty interesting feature that you are using.
I mean, you gotta know where you put your money, right? So I'm gonna share my screen again because it makes it very easy to see. It basically says, okay, this is the 11 stocks within the sectors for the S&P 500, and these are the ones that are holding the most money. So if we wanted to look at the current price for each one of these, we're basically saying that Amazon has $233 for the current price, but I'm not gonna enter that until it's 205. So I'm still thinking it's gonna drop. And I also don't want to enter for free. I want people to come and say, you know what, Alejandro, we know that you're going to be putting money in the market. So we're going to pay you to put money in the market. I'm like, thank you. Thank you for your consideration, right? So they're like, if the price drops below 205, we're going to pay you 75 cents for every share that you buy. I'm like, that's perfect. I want Amazon to be, I want to hold 200 shares of Amazon in my portfolio once it drops to $205. So I sell the put to expire on Friday. If it drops below 205, I get my 150. Now I hold Amazon. My risk is if it drops a lot after 205. But what we have seen for Amazon is that it's holding a support price right around the $205 range. So I don't expect it to drop much more below 205. And if it does, I expect it to go back up. So I don't have a lot of risk when I sell it at that price. Same thing for Coca-Cola, right? Coca-Cola, I'm saying that the support price is 102. The market agrees with me. That's why the premium is 0. And the current price is 117. But because we're on bear market territory, I'm not going to go and buy at 117. Instead, I'm going to wait and I'm just going to do Coca-Cola at 102. Same thing with Google. Same thing with, I'm sorry, this is COP. This is not Coca-Cola. I forgot which one this is. CO is Coca-Cola. So this was my mistake earlier. I quoted the wrong ticker. That's why it's important to have the company name. So ConocoPhillips, that's energy. Google Alphabet, here's Coca-Cola. So Coca-Cola is 83. And my support price for that is 71. But again, the premium is 0. So the market is saying we don't actually think it's going to drop that low. The algorithm thinks so. So I'm going to go with the algo because my algorithm tends to be right. So I won't enter Coca-Cola until it gets close to 71 because that's the support price before the next earnings call, and so on and so forth. So this is how the algo continues to tell me what to buy and what to sell.
And in the final end, you have like nice diversified portfolio during falling times, and using options, basically like selling insurance or like buying on a better price than the market gives you.
Oh yeah, well in this case, if I bought this entire portfolio, it would cost me 100 shares each would cost me $352,000. The market would pay me $581. Anything that gets assigned will be assigned on Friday, so in about 5 days. By that time, they'll give me $581. If I enter the market, I'm entering in a very safe place. And then at that point, I can, choose to exit. So for example, this one, Eli Lilly, this is healthcare. So I'm telling the market, I will enter at 1060. The market is saying, okay, right now it's selling for $1,200. I say, okay, that's fine. If it drops $140, I'm going to buy it. The market's saying, thanks for your trouble. Here's $10, right? So, from my point of view, I am entering this stock. I'm pretty certain that it will not drop below 1060 because that's what the algo said. But even then, the market is telling me because you are willing to insure this particular stock at 1060, we are going to give you 9 cents per share, right? For microtech, 672.50, and they'll give me $3 per share. So this one is pretty good. I'll make $300 for even 100 shares that I buy, but I have to make sure that I have at least $67,250 in my portfolio so that I can buy this if it gets assigned. Anyone who's following Micron will know that this stock has not dropped below 800 for quite a while now, almost 4 months since it was below $700.
This is nice. So it's only interesting thing will be like to test how often actually it breaks the support, right? And we will
Yeah.
have this statistic soon, hopefully.
Well, and the easiest way to determine that is based on how much money is in your portfolio, right? Because if you start with $100,000, you follow the algo, and you end up with 90,000, you just lost 10. But if you end up with 110, you just made 10%. So it's not that difficult to figure out if you have a profitable portfolio or not. The important thing what you're investing during bear market territory is that, first of all, you do not panic and sell everything, because if you panic and sell everything, you're going to sell at a loss, right? And then the second thing is, don't blindly buy things that you think are going to go up in price without doing a little bit of research. Trying to make sure that the things you buy are going to hold their value and it fits your investment strategy. Like, if you were to buy Netflix back in 2005 when it first came out, you probably have like a few $100,000. If you buy Netflix today, you might lose money, right? Netflix is not doing great right now. So this is why it's important to figure out what are the companies that are going to hold their value, where do you get your information from, and are you following the fundamentals, right? Don't just buy on the technicals, because the technicals are very momentary. The fundamentals are long term.
It's like the strategy and the tactics, right? So always take the strategically correct moves and make tactical decision and tactical.
Exactly. Exactly. And that's it. That's everything we had for today. You have anything else for us, Serhi?
I think now probably one comment that a lot of people are asking like why we are sharing like all of the sensitive information of our portfolio. And basically, I think the easiest, the most interesting part that we have a huge system, backend system that has AI and makes all these rankings and predictions, which is like our IP and our like know-how how to do it. And the rest, we are just sharing results, how we are moving along, and our successes and failures. So this is how it goes.
Yeah, I mean, we want to be transparent. Like, we don't want to go out there and tell our audience something and then do something else behind their back, right? So we're transparent. Like, we're like, this is what we're doing. That's why a lot of times I'll say something and we won't cut it, right? We won't edit, because we're people, and when you're people, you might say something incorrectly. But we want to stay up transparent in our channel. So we try not to edit. Whatever is said in the channel and whatever we show, we stick to it.
Yep, absolutely. So you can see our progress, you can see what we are investing. So like assuming that by the date this episode goes live, so basically like we'll have updated portfolio by now at that moment. So come to us and we will help you with your ideas and investments.
Exactly. All right, everyone. We will see you on the next episode. My name is Alejandro. This is my co-host Serhi. We wish you all a very good weekend, or a very good rest of your week. Actually, it's Monday today.